Hello and welcome back to the Property Investors Handbook. My name is Adam Bell and I'm your host, and today we've got a special guest in the studio for the second time, Mr. Tony Sutherland, who is an accountant and has been for many, many years and knows everything there is to know about taxation and accounting for investment properties. Tony, welcome to the studio.
Thanks, Adam. Thanks for having me back.
Excellent. Now, today we're going to open up the can of worms that is self-managed super funds and how that works for property investment, because I know there's a lot of legislation and a lot of things to know, isn't there?
Oh, absolutely. As soon as you join a property into a self-managed super fund, you bring a whole new set of rules into the equation.
Yeah, I remember listening. You had that episode with Colleen a few weeks back, and there were things that you brought up there to do with self-managed super funds that I just had no idea about. Totally different set of rules. So, look, let me first ask, why have a self-managed super fund that you can then use for property investment?
A lot of people look down the road of a self-managed super fund. I guess they look at what they're getting in terms of returns and cost of administration using through a master fund, your big industry funds.
Yep.
And a lot of people do and think they can do a better job in terms of returns.
Right.
So they look to manage it themselves.
So it's
simply.
generally about doing that and getting a better return than having it in a normal super fund itself.
Yeah, exactly. You get very little say through a master
Yep.
fund in how your investments are invested, your funds are invested. So some people like to be hands-on and try and get better returns.
Okay.
Yeah.
So talk me through buying in a self-managed super fund, getting a property and the ins and outs of that.
Yeah, look, it's the main reason people go down that road generally through the self-managed super fund is that they've got funds there to put into a property. Sometimes if they've already got investment properties outside of super, they've used the available equity that they have to borrow outside using their own home as additional security that the banks need. So it's if they've got several $100,000 in super, it gives them a kickstart that's their equity start to buy the property.
Sure. Okay. So how does it work?
Okay, it's the super fund buys a property just like anyone else, like
Okay.
whether it's the individual or a trust.
Sure.
It needs to borrow to do the settlement generally.
The entity itself borrows the money?
Yes,
Yep.
yes. So
Okay.
it's the super fund borrowing the money. I'll come back to this. There are some rules and structures
I'm sure,
how that happens
I'm sure.
with the borrowing, but we'll get to that. And so the super fund buys and the super fund borrows.
Okay. All right. Talk me through those rules then.
Okay, so let's say you set up a self-managed super fund, you've rolled your super money into it,
Yep.
and you've got it in cash. That's your equity component.
Sure.
Okay, then you've
Just like saving for your deposit.
exactly just like everyone else. So then you go down the road of having to borrow. Now there's a special rules around that, and it's called limited recourse borrowing arrangements, LRBA for
Okay.
short, where the banks, whoever you're borrowing from, have to comply with the rules around that.
Sure.
Okay. I'll start by saying that when there is borrowing, the super fund has to then set up a separate bare trust.
Right.
And that's to comply with the LRBA borrowing rules. Now, it's a little separate trust that's controlled by the fund and the trustees, the members.
Right.
It sits at the side and does nothing. It
Okay,
doesn't lodge tax returns, doesn't do anything.
But it's got to be there.
But it's got to be there. It's officially the holder of the property
Okay.
until the loan is repaid.
Right.
So
okay.
it just sits there doing its
Yep.
nothingness, but it has to be there.
But effectively owns the property during that period.
Yeah, exactly.
Okay.
Exactly.
Sure.
So so you'll find a lender who will lend on the terms of the LRBA. Now they're a little stricter around those rules than a standard borrowing arrangement for an investment property.
Yep.
The ATO are really forcing more control of that. So they tend to say to the borrowers a 60-40. So a 40% equity, a 60% lend, the LVR rules.
Right.
So it's a little bit more restrictive on residential property.
Yep.
Commercial property, they're allowed to push out a bit more to like a 70-30
70-30.
LVR.
Okay.
So it is a little tougher than just walking in, to a normal bank, normal investment property where they might do 80-20.
Sure. Now, with this structure and the way it's set up, and it's the fund that's purchasing the property and borrowing,
Yes.
how do the banks look at serviceability, your ability to repay?
Yeah, it's a little bit different to the normal borrowings because obviously, and what the limited recourse borrowing, I should explain, is that the banks technically only have recourse to that property and the superannuation fund if they need to call in the loan. So they will still ask for guarantees from the fund members.
Sure.
But that's all. They can't, then the bank can't go outside the super fund to collect the money if you default.
Sure.
So that's why they look at serviceability quite strongly. And that's going to be around the income of the property that's bringing in, plus other funds coming into the super fund. So if the super fund has other monies invested or it's receiving annual contributions from the members, they'll look to make sure that's going to sort of be a regular thing that's going to service the loan.
Sure. Okay. Now, I believe one of the key differences with having an investment property in a self-managed super fund to, having it yourself is what you can do to the property.
Exactly.
So can you talk us through this little landmine?
Yeah, so it's a very big landmine, in terms of the property. So when there is a loan in place, an LRBA loan in place on that property, you're very restricted in terms of what you can do to the property in terms of improvements. Okay, let's say you buy an investment house, you rented it out. You can do your normal repairs that are required to keep it in livable condition.
Yep.
But then you are prevented from improving the property. So, you can't then come along and say, I want to add a bedroom to it.
Right. So
or do garages or carports or things like that.
Right.
Until that loan is repaid.
Can I throw you a quick curly one, Tony, and ask why?
Yeah,
like it is what it is. I get that, but why?
Push it back to the ATO. That's their rules they brought in around limited recourse borrowing arrangements, that the property cannot be improved until that loan is gone.
Right. So
it's a strange rule. I don't know why, because if you could improve it and improve its rentability or its income producing ability, that would be a good thing.
Yep.
But the ATO have these rules around.
All right. So to get this clear for everyone out there listening, I'm going to throw things at you about what you can do, and you go yes, no.
Okay.
Curtains.
Yes.
Okay. New shower.
Yes, provided it classes a repair. So if the old shower needs replacing, new shower.
New bathroom.
If it requires
Same thing.
replacement.
Knock a wall down to open up the living room.
You would say no to that. It would be deemed as a capital improvement, and that would fall foul of those rules.
Okay. Add a sunroom out the back.
No, definitely not.
Okay. New carpets.
Yes, they're okay. They're just an ongoing maintenance item.
Sure. Let's say you wanted to extend a window, so make a longer sort of bay window area.
Again, that'll be a grey area one.
I'm trying to throw you some hard ones here, mate.
It'll be a grey area one. Look, more than likely that would be okay because it's not really sort of a structural improvement in any way. If it's just improving the livability or the rentability of the property, would be okay.
Sure. Okay. So give me a few then overall do's and don'ts when buying an investment property with a self-managed super fund.
Okay. So firstly, do your research. Do speak to your accountant, do speak to your lawyer, particularly around the rules of the borrowing arrangements, because that's very important. So do that. Do your research on the type of property that you're looking to buy in there. Do your homework on the rules around the borrowing, like the 60-40 lend on residential. Make sure that you can afford it, or the super fund can afford the arrangement that you're looking to enter. Don't buy a property and then start doing major improvements to it.
Without getting it checked out.
Without getting it checked out first. Do not rent it out to a relative or an associate, what they call.
Okay.
That's a definite no-no. Under any super fund renting a property, it cannot rent it to a member.
I was going to say, is that your advice or is that
No, that's
a
a
law?
rule. That's a law.
Right.
You cannot rent it to yourself or a relative,
Okay.
or what they call a Part 8
Right.
associate.
Sure.
So so it has to be everything in terms of the rental has to be very arm's length.
Okay.
So, rent it through an agent, make sure that whoever they're renting it to is not associated or related to you.
Sure. Okay. And what does somebody who gets an investment property through a self-managed super fund need to really think about and consider coming tax time each year?
Again, it's the superannuation fund has to comply with all its tax rules. So when you've got a property in a super fund, let me go back a step. A super fund at the end of each financial year on the 30th of June has to value its assets at market value on the 30th of June.
Right.
It's just one of the rules. So instead of at cost, it needs to be at market value so that it knows what the value of the fund is on that date.
Mm-hmm.
Now, and that includes the property. So just recently, the ATO brought in and upgraded their guidance rules in that property needs to be valued like all other assets on an annual basis. Right. So that's the biggest issue around that. Firstly is that the property has to have some sort of market appraisal by either a registered real estate agent or a registered valuer to what its value is on that date.
Right. Okay.
So that's the biggest issue. And of course, a self-managed super fund or any super fund has to have an investment strategy. And you need to review that each year to make sure that investment strategy aligns with your superannuation ultimate retirement plans.
Sure. Okay, great advice. Last question for you, Tony. What happens, you've got a property in your self-managed super fund. What happens if it comes time to retire?
Yeah, this is where the issue ties up with your investment strategy. You've got to look at the availability of funds to fund your retirement. Now, if you've got a property that's the majority asset of your super fund, that could be problematic in having enough liquid cash to fund your annual retirement. For example, someone retires at 65, goes in, turns on the pension mode or pension phase of their super funds and says, I want to retire. So that person between 65 and 70 onwards has to take out 4% as a minimum of their pension balance or their member balance each year. Right. Now, if there's not enough cash, how do you fund that 4%? Sure. Because that's a minimum. Yep. There's no maximums, 100%.
Got to do 4. Yep.
You've got to do 4. Now, then you may get to the point where you may have to liquidate that asset into more cashable type investment to fund the retirement. Yep. So you got to plan ahead for that. So it's not like get to retirement, then what'll I do with the property? You might have to be selling it quickly. Yep. And that could push you into a sort of forced sale type scenario. So make sure you plan ahead, like 5 years ahead for that possible scenario.
Planning ahead, always key.
Yes.
Look, Tony, thanks so much for coming in today. It's been an absolute pleasure having you here, and the knowledge that you've got on these, quite difficult and complex topics to do with accounting and investment properties, I know is going to be very well received by our listeners. So would you come in again and do another couple of episodes with us?
Yeah, of course, Adam. It would be my pleasure to come in and do some more.
Fantastic. Now, remember, if you're looking for any type of advice and services around investment properties, do see Colleen and her team at, what is it? It's spmg.com.au. Head over there, give them a call, send them an email. They're the best property management agency in town. And, of course, if you're looking for any accounting services and advice, Colleen and her team can definitely point you in the right direction there as well. Tony, thanks once again. I really look forward to speaking to you again in future episodes.
Thank you very much, Adam. Thank you.